Welcome to the Profit-Led Podcast, where we discover proven growth strategies for bootstrapped entrepreneurs from the people who have done it before to help you accelerate your business. The Profit-Led Podcast is brought to you by eWebinar, the leading automated webinar platform, which could save you from doing the same webinar over and over again. From sales demos to onboarding to training, eWebinar turns any video into an interactive webinar that you can set on a recurring schedule or make available on demand, which means you can do hundreds of webinars without ever needing to actually be there to host them live. This podcast is a forum for the unsung heroes of SaaS, the founders and others behind bootstrapped startups who are creative and resourceful enough to forge a pathway to success. Here is where they get to share everything they learned along the way, so you can benefit from their experience and find success in your own ventures too.
Welcome to Profit-Led, the podcast for bootstrap entrepreneurs looking to make it happen. My name is Melissa Kwan. I'm the co-founder and CEO of eWebinar and your host. My guest today is not the typical bootstrap founder that we have on the show. He's actually the opposite. His company raised almost $1 billion and it's only 2 years old. I invited him here today because his company actually helps fund startups with non-dilutive funding so they don't have to go and raise venture capital, giving them another option to grow their company without selling equity and adding more people to the cap table. We're here today to talk about what non-dilutive funding is, what you need to get funded, and how it all works, if this is a path that you want to take. So here we are today with my special guest, Miguel from CapChase. Hey, Miguel, how's it going?
Hi, Melissa. Thank you so much for having me here and for the intro. I'm really excited about this.
Well, thanks so much for coming on the podcast. As you know, we've been planning this conversation for weeks now, and I asked you to bring a drink today so that we could have a virtual drink together. So what did you bring with you?
So I brought a Diet Coke. It's not very original, but the reason why, I need caffeine to get through the day. Just like I'm having coffees or Diet Cokes during the whole day, but then I'm trying to not have sugar. So then this is kind of like, it has the best of both worlds, and too much coffee is just too much, you know?
It's like fake sugar. So I actually, the opposite of you. So I'm actually in Vietnam right now, and I passed by a Japanese grocery store this afternoon, and I got this Japanese kind of coffee blend. And this is actually one of those things, have you been to Japan before?
Yeah. I was in Japan. I love it.
Yeah. So this is one of those things that you find in every single vending machine. So I thought it's perfect right now because I just got here not too long ago and I'm still jet lagged. So I kind of feel like I need this. So shall we open it together and create some ASMR magic? All right.
Let's do it.
All right, so I got a glass in here too. So
yeah, when I was living in Japan, I was getting around with that kind of coffee and then those wrapped sushi triangles that they also sold in every single store.
Like every train station.
Exactly.
Yeah. Those are called onigiris. And actually, a funny story, I once so I live in Amsterdam mostly, and there's a lot of like very late night parties. And in Amsterdam, they don't check your bags. Like they don't check your bags. They don't check your ID. And I guess it's Europe, right? So I always bring a snack because you usually go till like 5 a.m. and I usually bring a snack. So I brought one of those triangles with me, but I only brought one. So then I ate it at like 3 a.m. And after that, I realized I needed like 20 more because it was so small and it made me so hungry afterwards.
And they're still addictive too, yeah. I love them.
Anyways, well, cheers.
Cheers. Cheers.
So I thought we'd start today's conversation by digging into your story a little bit and what led you to start CapChase, which we are a customer of, by the way, at eWebinar. And then we can go into how funding actually works if any listeners today actually want to go that path. So Miguel, with that, would you tell us a bit about yourself, who you are, what do you do?
Yeah. So I'm Miguel, co-founder and CEO of CapChase, as you said. I'm originally from Spain. So grew up in Europe, actually, like going to clubs and not getting checked. It was, like the normal thing for me until I came to the US. So I grew up there. I studied engineering, so mechanical engineering in Madrid. And then I went to Munich for 2 years, one of those like European exchange programs, and did a master's in energy engineering, mostly nuclear and renewables. And then I never worked as an engineer. So I worked in consulting and then I worked in SaaS for 3 years. I joined a pre-revenue company as the first sales employee. And then I built and led sales and customer success. and then international. And it was actually during those 3 years where I was exposed to most of the, opportunities and also challenges of a SaaS business. And particularly in my team, one of the main challenges was actually getting people to pay up front, which we would then use as our main source of funding, right? Probably something that a lot of bootstrappers go through, right? Like you need to get paid up front because you're incurring all this upfront costs, CAC, and then paying your sales commissions, then sometimes implementation costs or data costs to get somebody onboarded. And then if they pay you monthly, it's like you're financing your customers, right? And as a bootstrap company, you just don't want to you don't want to finance your customers. You want them to finance you. So we needed all the cash up front, right? So we would give large discounts. And actually that was the insight that led to Capchase. We're saying, how can we help SaaS companies to actually close more deals by, offering flexible payment terms to the customers, but also need less financing by getting those customers to pay up front. Kind of like trying to bridge the gap.
Is this your first company?
Well, I started 2 companies before when I was in consulting, but part-time only. And they were just like not good ideas. We made a ton of the mistakes that, usually like if you have no idea what you're doing, you make, right? Like asking our friends to validate the idea. So everybody was like, yeah, the idea is amazing, like you should do it. And then we did it. And then they were like, nah, I don't really want to use this, right? So that was one mistake. And that mistake was doing it part-time and not being like fully dedicated. And then I guess that unit economics were really bad. Like we didn't do enough planning and enough experimentation before launching. And then when we launched, everything was just like not the way that we thought it was going to be. So we just, good learning lesson and moved on. Yeah.
Is it with the same group of founders that you're with now?
No. It was totally different. Yeah.
Yeah. I mean, I think it's funny you say that because I actually wrote about this, that you should never ask your friends and family for advice on your idea because they will never tell you the truth. And actually, I think the best way to validate an idea is to ask someone to pay for something. Ask people to pay $10 and they will tell you everything that's wrong with it. But of course, your friends and your family, they want to protect you. And it doesn't hurt to say, yes, it's great. And then you get all this false validation and you do it. And to your point, like it doesn't work. Right?
100%. Do you get an idea? One was like the Airbnb for sports equipment and for gadgets, right? So then we did a survey. We spent time thinking about the questions. We sent it to our family and friends. They sent it to their family and their friends. So everybody was happy to participate. And right now, if I were to do the same thing, I would have gone to people, like put some Facebook ads like, hey, you have an upcoming race. Do you want to rent this bicycle for $45? If nobody clicks on it, you know that the idea is really bad. And then you just move on. So yeah.
So were there moments before Capchase that kind of got you to where you guys are today? Like, were there certain things that you learned from your consulting or your previous ventures that kind of like led you to this?
Yeah, I think that, we learned a lot in the SaaS company for 3 years as we stood the company from like 0 to a few million ARR, from like 9 people to 70 plus people. There were a lot of things, and like, not just, go-to-market things or funding lessons, but also about scaling a team, people management, going from like everybody does everything to specializing people in certain things, how to set up processes, how to promote ownership and accountability in people and get them excited about it. And all of that has been critical for Capchase. And honestly, like right now, we're just figuring out a lot of things ourselves as well, because, we've grown way beyond where that company got to. And now it's all about finding the best people that can draw on their learnings to take the company forward.
I mean, you're very different than the typical bootstrapper that we have on this podcast. And I'm curious, what is it like running a venture-backed hyper-growth startup?
It has some pros and cons, right? So let me start with the biggest con, which is like probably like a cliche. It's suddenly like you're not the owner of your destiny, right? Like raising money from VCs puts you in a trajectory where you have to shoot for the moon, right? And if you don't hit the moon, you may get like acquired in between, but sometimes you're just gonna crash. So then like this model works because VCs are highly diversified, right? So then they want all like moonshots, right? And then they don't care if 90 of those moonshots don't work, as long as the other 10 or one of them is incredible and returns 100 to 1,000x of the investment, right? Then it's amazing. That investment has paid for the whole fund. The VCs are perceived as geniuses and the whole model works. Which means that the other 90 that don't make it are spending times of their lives doing something that in the end is just not going to have that much of a return. Sure, they will learn a lot. They will be exposed to amazing things, but it can be very demoralizing to work on something for 7 to 10 years of your life and then make something material, right? So that is, I guess, the biggest con. The pro is that given that you have more capital, you can invest it into more initiatives or put more fuel behind the same initiatives and then get faster feedback loops. And if you hit product market fit, then you have really large amounts of money to deploy and to grow, right? That, again, has another con, and I'm sorry, I'll wrap up here, which is that too much money can lead people to make wrong choices, right? And you feel like money doesn't matter because you have so much that you can do this alternative and this one and this one and this one, as opposed to being very picky about what you do.
I mean, is that the path that you guys intentionally wanted to take? Had you evaluated, okay, we can do it this way or this way, and we're going to shoot for the moon?
I think that yes and no. So on the one hand, our model, given that we are providing financing, we're launching new products now that are less capital intensive, but given that providing financing to other founders, we need to show skin in the game, right? So everybody we've raised over $100 million of equity and then almost $900 million of debt, right? So that debt, whenever we give that money to another founder, we need to show skin in the game. So we need to put some of our equity. So then we need a lot of money to grow, right? So that's one reason for raising VC. And the other one is that it's such a big market and it was such an untapped market that having capital to grow and gain market share rapidly was very important, right? I think that if the products that we're launching now, if we were to launch them back then, probably we would have needed to raise way less money until we hit product market fit and then maybe raising a little bit more. But once you've hit product market fit, if you raise, then you're just diluting yourself way less. You can control much more of your destiny and so on.
Yeah. I mean, can you give us an indication of how big you guys are today, maybe in terms of number of companies funded, or I don't know how you measure, is it by amount of capital deployed?
Yeah. So we've made available over $2 billion at this point to founders, and they take it, they deploy it, and then as they pay back, they can take more and so on. And then we're working with, I think it's 4,000 companies at this point. We are present in 11 countries. So mostly North America, that's the biggest portion of our revenue, but then also Europe, both the European Union and the UK. And yeah, we're now launching new products, trying to solve more pains for founders, mostly around revenue management and things like that.
And what's the hardest thing about all this that you're doing right now?
I think the hardest thing is, to me, it's scaling, right? How do you go from being a 5-people team to a 20-people team to a 100-people team, and how, the different roles, responsibilities shift? You're constantly undoing things, unlearning things, and then doing them again. And that is, at some point, I'm sure you experience it as well, as CEO, a lot of the different escalations end up reaching you. And those escalations are more frequent, the less organized the scaling is. And, there are moments of chaos in every single org. So I think that to me is the hardest thing, which can get solved by hiring amazing leaders, right?
Yeah. I mean, do you still feel like a startup? How do you stay nimble and move quickly, which is one of the benefits and competitiveness of running a startup, but also as your company gets larger and there's more people involved?
That's an amazing question. I think that we do feel like a startup. I want to be a startup, but then as you grow in size and you start bringing more leaders on board and more departments, and suddenly you have a legal team and a people team and a credit team and a risk team and so on, there can be a tendency towards two things. One, incrementalism, and then asking for permission, right? So to explain those two things, incrementalism is when you don't want to make mistakes. So then innovation and new products are geared towards making current products a little bit better, right? It's more like adding features that. You have to avoid it at all costs. That's a big corporate thing, where people are afraid to fail and they just want to hit wins. And in a startup, you need to constantly head for the moon, right? Like if you're launching new products, like make new products people really want. Don't improve your current products, right? The way that we are solving that is by putting our best people in the new products so that the org doesn't develop antibodies for innovation, right? You want best people to drive things that can have outsized impact. And then two things, asking for permission. Suddenly when you have multiple teams, it's very easy to say, hey, let me just get this other person's thoughts on what we're doing, or let me run this by somebody. And then suddenly you're adding latency to the system and just walking in circles. And then that doesn't drive the company forward either, right? So how we solve that is by giving people full ownership of initiatives, regardless of the level, right? So you don't have to have authority to drive something forward. You just need to have ownership, accountability, and then the leaders should just take roadblocks out. They shouldn't even be bottlenecks, to give a go ahead.
Yeah. That's what makes people also feel maybe attached to the company, right? Like they feel like they're a bigger part of it because they're actually making decisions. And they know that their decisions matter, right? I think that's most important is like they know they're making an impact. I mean, so I want to switch gears a bit because there's always been discussions around like bootstrap versus venture-backed and more prevalent now than before. And especially now there's a new class of capital, right? Like you guys commonly referred to as non-dilutive funding. And as a bootstrapper myself, I'm a huge fan because previous to this, there wasn't another way to get meaningful capital in a very short amount of time, and especially without selling equity. And to me, selling equity isn't the issue, right? Like it's more that there's no perfect world because I don't want to go the venture route, but the only other path is family and friends or myself, right? Which isn't always great either. Or you can go to an angel or family offices, but then you're still needing to take that time to build that relationship. So for me, like none of that is great or optimal. So who would you say like Capchase was designed for? Like when you guys were designing this company or product, like was it a certain type of founder that you had in mind or like a certain type of company?
Yeah. So actually, like when we started, the first 20 people that we talked to, they were all VC-backed companies that were trying to get less diluted. And then what we've seen is that, what we've seen like after 2 years is that 50%, almost like to exact dot, are bootstrap founders and 50% are VC-backed, right? So there are a few explanations for that, but why we started with VC-backed companies was because we knew how much dilution hurt, and you don't feel dilution until you've actually sold part of the business, right? So then like founders were actually like, especially second and third time founders were the ones that were the most conscious about it because they knew that they had exited companies and they knew that if, they had been working for 5 years and they had like 3% of the business, right? So then it's like, okay, what if I had like 30%? Like that would have been like, 10 times better. So we started speaking with them mostly to help them to fund predictable and repeatable initiatives. Mostly user acquisition, implementation, things that you're going to get a certain return. And that return is always higher than the cost of debt, right? But sometimes not higher than the cost of equity. So then as we started speaking with bootstrap founders, we got exactly the feedback that you gave. Like, this is an amazing way to get more resources to grow and put you on a steeper growth curve than if you're just waiting for those customer payments to come through, right? Or to avoid deploying your own funds.
I mean, that's interesting that you guys started with venture-backed founders, right? I would have never guessed that. Having talked to so many venture-backed companies and working with the founders, like, was there some commonality that you saw with them? Like, at some point, was there a flip on like, oh, I don't want to raise any more VC funding? Or like, did they just not know from the beginning that was going to be the game they were playing?
Exactly. I mean, it's actually both. So second and third time founders, they got it immediately. They were like, this is exactly what I need. I wish I had this 10 years ago when I was doing my previous company. So they got it instantly, and they really optimized much more for capital structure, not just equity, but other, things. And then the other catalyzer actually was COVID, because suddenly every single VC-backed company or every VC-backed founder had access to debt, primarily given in the form of government subsidies, both in the US, Canada, and then Europe, everywhere, right? Like all these countries were giving payroll protection subsidies or loans that were paid over, a few years. So very, very cheap capital. And then suddenly founders saw that, hey, one, there's other sources of funding besides VC. And two, debt is okay. As long as you can build it into your models and you know how to return it, and you align it with payments from your customers, it's okay. So then that sparked another massive change. And then we started getting like a mini brand in the space and so on. And then that started to also to spread. And founders talk to founders, right? So they talked about it all the time.
And what are your personal thoughts on startups raising venture capital versus other financing options?
Yeah, I think that it accelerates some feedback loops, and then it can enable companies to capture a lot of market share. I think in some industries where the products are not that differentiated, it's kind of necessary if you want to gain a lot of market share and like own the space. But it just adds a lot of stress as well, right? So again, like you are suddenly in a different trajectory where you need to grow extremely quickly, or suddenly like there is a zero cash state, right? So you need to grow extremely quickly before then. So then like that aspect of, like some people are just like not wired to work when they're burning money. Personally, I would love to be like cash flow positive, because then like you feel like you're the owner of your destiny, really. And then it's like, look, it's up to us, there's not zero cash state. But then again, like when you raise money, like you can get advice from people that have done it before. And if you choose your investors, then it's great, right? But yeah, it increases the stakes, both for good and for bad.
I mean, I think a lot of founders, especially first-time founders, don't understand that. I personally think the media has really skewed our idea of what success is, right? It's almost like if you get funded, it's a permission to build a company or it's permission to be successful. And then you get all the spotlight. And especially if you're living in places like, the Bay Area or New York, where everyone around you is raising money and you feel like, well, I have to raise money. And I lived in New York for a few years and I also felt that pressure, or at least felt the pressure to pretend that's what I wanted as well. Because otherwise, maybe I wouldn't be ambitious, right? But I do think like now, especially after COVID, so many more people are talking about being profitable and, controlling your own destiny and how that's just a different form of success.
100%. And actually, like, I really want to hone in on this, right? A lot of people, especially in the past few years, have confused, like fundraising success with commercial success. And fundraising, it's just, a step of the way. It can signal buy-in from investors, but it certainly doesn't mean commercial success, right? Commercial success is when you build something that people really want to buy. And then that actually can fund your operations and, eventually turn into amazing profitability down the line. But a lot of people miss that view and like they just focus on fundraising. That's certainly not it, right? Nobody wants to build a company to fundraise. They want to build a company that can create returns for investors.
So what kind of companies would you say are best suited for non-dilutive funding? Hey, I like to take a second here to talk about my own company, eWebinar, and our mission to rescue people from what I call webinar hell, to give them back their time and save them literally hundreds of hours every month through webinar automation. If your sales team is tired of doing the same demo over and over for unqualified leads or worse, prospects who don't even show up, an on-demand demo powered by eWebinar can help them get their time back so they can close more deals. If you're doing customer onboarding and training on repeat, eWebinar can help you automate those so you never have to do them live again. Customer success teams are using eWebinar to run hundreds of sessions every single month without a live host. Why don't you give our product a try and see for yourself? Visit ewebinar.com to join our own on-demand demo or to sign up for a free trial. All right, now that I've gotten that on my system, let's get back to the episode.
I think that one, companies that have revenues, because this is like revenue-based financing, like the more revenues, the more material it is. And then companies that have a grasp on their unit economics, right? So the thing with non-dilutive funding is that you actually have to return it, right? So
yeah, it's funny that way.
Yeah, exactly. So then like if you have unit economics, and your metrics right, and you understand them, then you can just bake that financing into a model, and then everything turns into like a flywheel, right? And the more you grow, the more funding you can deploy, the more funding you deploy, the more you grow again, and so on. So I would say like that is probably the key thing, because I think people get into trouble when they try to get financing, non-dilutive financing, and then they use it either for things that don't have returns. Imagine for furnishing a new office or whatever. Like that doesn't really make sense. That's not going to turn into more revenues or more customers, right? Or when the return they're getting from acquiring new customers either takes much longer than you thought or is way lower than you thought, right? So to help with that, like we developed also an analytics product so that founders can understand, what their LTV looks like, what the CAC looks like, what the payback looks like, and a bunch of other things, combining expenses, revenues, and accounting and banking data.
Yeah, I'm actually really surprised that Stripe doesn't have a great analytics product for that. Like we keep our own Excel sheet on like projections and things like that, but I enter all those numbers. I update it once a month. And that's actually one of the, like learning how to do financial projections was probably one of the most useful things I've done because it just allows you to visualize like, can I hire this person? Right? Which one of my subscriptions are actually driving the most revenue? What does my growth rate have to be? But a lot of founders don't know how to do that. But actually, every time I log into Stripe, I'm like, why? Like, you have all my data, right? Like, why doesn't it just spit out something that gives me the same kind of view? I think ProfitWell is as good as a product could get, but there's still certain numbers that aren't there because they also have to serve a lot of different industries as well. So I'm glad to know that you guys are coming up with that product. To your point about companies using non-dilutive funding or your capital for different things, what are they actually coming to you to look for? Like, what are they actually looking to do with that capital?
Yeah. So here's like the main differentiation between bootstrapped and VC backed. So bootstrap founders, like they use it for everything, right? What we've seen is that bootstrap founders generally are way better at managing cash. Way better because they
don't have a choice.
Exactly. Yeah. They're used to like knowing exactly how much is going to come in, what they're going to use it for, the impact that's going to have. So it's like incredible, right? So then they're just like incorporating it into part of their funding structure and usually taking, frequent gradual draws, but usually to fund like pretty much anything, right? Because they're like, look, this is my source of capital and these are my expenses and investment needs. I'm going to just deploy. VC-backed companies, on the other hand, are not as good at managing cash, but they are good at deploying a lot of cash into certain things, right? Primarily user acquisition. So then what they're using it for is mostly for that. So things that are repeatable, which are honestly like investing in ads, investing in salespeople and paying for the ramp up, until they start producing, sales commissions, implementation, and so on. And essentially getting their CAC paid back on day zero through CAPTCHAs, right? Artificially. So then what they do is they can invest only into growth. They get all the money back, and then when the customers start paying, then they start paying CAPTCHAs back. And they do this every month so that they are not using their VC money, which is the one that's extremely, extremely expensive, to fund activities that are honestly like have an unlimited upper limit and then, are very repeatable and predictable.
I mean, when I hear you talk about that, I almost think like, because as a bootstrap founder myself, I have to be very, very revenue focused from day one. Even for eWebinar, we probably spent an extra 6 months building it because I wanted people to know that on day one, when they signed up, this is a trial and you're going to pay at the end of it. Like there's no beta, there's no alpha, you're going to pay because I don't really have another choice. But I think a lot about how throwing money at things can actually create a false illusion of success. Like, yeah, you can buy users. If I had $1 million to throw at ads, I would be able to buy users, but maybe they churn in a couple months, but I'm just buying more. I'm buying more. So as you're talking about that, I almost wonder, like, does that kind of spend create a false illusion of what you had mentioned, commercial success?
Totally. And that is, I think Chamath had a chat, explaining how this is kind of like the biggest like pyramid scam of Silicon Valley, where it's a perfect funnel of LP money all the way to Google and funding companies success. It's one of Chamath's things, but there's some truth behind it, right? Like you can buy users unprofitably, and the more money you buy, like the more users you can get. And then that can mask growth. But then like it's all about the net retention, as you said, right? So at some point, the money that you need to deploy to continue a rate of growth is exponential with respect to that growth. And unless you've worked on a product that people actually want and you can retain them and you have a positive LTV to CAC, then everything unravels, right? So you're so right. Like we've seen it like super graphically with all the fast delivery companies. They were spending, a bunch of money acquiring users that then would have negative gross margin and then they wouldn't stay. So, that's a very clear example of acquiring users that then have a negative value for the company.
I mean, that's the thing too. Like when you're really careful about why people are leaving, then you also get a lot of product insight. What's broken? Where can I fix this? How do I make the product such that people stay? Whereas if you constantly have a stream of people coming in, signing up, paying you for even for like 1 or 2 months, but you're constantly investing in that flywheel, it makes you think, oh, my product's great. People are coming in. I'm making revenue, right? And that I think is a dangerous place to be. So say a company wants to get funding from you guys, from CapChase. Are there minimum requirements, like minimum revenue requirements, or like what other requirements are there?
Honestly, like very, very few of the requirements. I mean, one would be the geography, just like North America or Europe, Europe, both European Union and the UK. And then $100,000 of annual recurring revenue. So that's about like 9 to 10K, per month today. And then 6 months of revenue generating history, just so that the system can learn from the data. And then honestly, it's just like, that's it. And then we connect to the data, and then the funders get an answer very rapidly. And then it's just off to the races, right? And then they can do it again. And as the company grows in revenue, then they get more availability to redeploy, right? To continue doing it without having to go through a full process.
Are you guys only funding tech companies, or are there other companies that you guys are also funding?
Yeah, only SaaS companies. So SaaS companies that have, SaaS revenues or hybrid SaaS. So SaaS plus hardware or SaaS plus services. But yeah, we have found that, we're best at SaaS and that's what we really understand. And all the new products that we're launching are geared towards SaaS, right? So we don't want to be like a horizontal play for everybody. We want to build multiple products to help SaaS companies and SaaS founders, just grow faster with capital, insights, and tools.
So first you connect your data, which is like financial data or, your Stripe data. Are there any other documents that are required for your team to actually go through the underwriting process?
We used to connect to banking data as well. So like you just can connect your bank with one click. Revenue, as you said, and then accounting data. And then we ask for the EIN or the equivalent, for some kind of like identifier for the company. And then we use our systems to like get kind of like the good standing data from the company and so on, just to make sure that we have to comply with some KYB and like know your business and anti-money laundering regulations and so on. But that's it. So it is really, really straightforward. When people compare with like other processes they've done, either raising equity or raising other types of debt, this takes like hours compared to months, So it's very straightforward.
And how long does it take to actually get approved and like to get the capital?
Yeah. So once we have the data, it's usually like about 24 to 48 hours to get approved. Like sometimes it's just like a time zone difference thing, where you get an answer like maybe 6 hours later than you would if you were in the same place. But that's pretty much it. And then the money is sent the same day, right? So I think the fastest process ever has been around like 35 hours from first call to money in the bank. I would say the median is more like 4 days, something like that.
Yeah. So that's faster than booking your first VC meeting.
You bet. Exactly.
Yeah. And what is the funding amount based on?
Yeah. So it's fully based on the ARR. What's interesting here is like the ARR is like the next 12 months revenue, right? It's not your revenue today. It's like the next 12 months revenue. So it can be very material. And the funding goes from like 10% of the ARR all the way to like 65 or 70% of ARR. So that's kind of like the maximum availability, right? So let's say that a company has 1 million ARR, they can get up to like, let's say 600K if the company is growing fast and has like good retention and so on. But then the main thing is that you usually don't want all that cash up front, right? Especially, if you're like not burning a lot of money or like you're not spending a lot of money in user acquisition and things like that. So even if the availability is high, what we usually recommend to people is that they take more frequent and smaller draws. Because what we want, both as founders, and as providers of the capital, is that the money is actually generating returns for you, right? For the founders. So instead of having a bunch of money in the bank that you're just paying interest for, taking a smaller gradual draws that you can put to work immediately. So then that minimizes the cost for you.
But what's the difference between a company that can get 10% versus a company that can get 65%? Is it just the length of time that they've been in business?
Things like growth rates, like the LTV to CAC, retention, and the curve of that retention, right? So imagine if a company loses, 80% of the customers after the first month and they retains 20%, that's a different profile than a company that loses 5% per month, right? So it's all about that. Like what we're trying to solve for is like, hey, if this company needs to stop all user acquisition today, like where does that get them to, and also like too much capital as well can be like bad for businesses. So what we're trying to solve for is something that's material enough to make a difference and also doesn't over leverage the company.
Yeah. And what's the fee structure and the payback period?
So we're launching actually new products as well, right? On the financing side. The fee structure is one upfront fee. That's it. And then it gets paid back usually month over month for between 3 to usually 12 months. In some cases, it can go a little bit longer, depending again on payback periods and on net retention and so on. And now we're actually launching a product that has a period of interest only for a few months to help with like payback, right? So that when founders are investing in new activities, they don't have to pay any principal back until those activities are actually generating returns.
Yeah. And is there like an average like interest range, or like does everybody get the same interest, or like how does that work?
Everybody doesn't get the same interest. It's more like a risk-based pricing. So the interest rate can go from like right now with like interest rates raising, it gets even more important to access the lowest cost of capital for everybody. And we are fortunate to have the lowest cost of capital in the market. So it goes from like, I would say like 5 to like 10% yearly. So it depends again on the size, on the metrics, on retention and so on. But what we usually see is that, as companies evolve, get larger and so on, then we can actually drop the unit cost of capital for them, which is, of course, very helpful for everybody.
I mean, I'm curious though, like why can't traditional banks do what you guys do? I tried to go to my bank when I was shopping around just to see what my options were, and they can't even talk to me because we're not profitable.
It's exactly. So there are two things. One, since the great financial crisis in 2008, the banks had all these risk models evaluated by the regulators, and actually having negative EBITDA, even for like the last year or 2 years ago, is almost like a binary element, right? If you have negative EBITDA, the system says zero. Like you just cannot access anything. And then the second option is that they don't understand it. Like they don't have enough comparable data to go and do the models and say, okay, this is a software company. It has zero assets, but the stream of cash is actually very valuable. They can't do that. They're like zero assets. Like we just can't lend against anything. So yeah, when you see like some banks in venture debt lines, actually they have to go through a different underwriting process. They cannot use their customer deposits for it, or usually they can't. And then it's usually the special trading desk that underwrites those businesses by throwing people at it, right? So it's like, it is still like a very untapped segment for banks. But when you reach a certain level, let's say 20, 30, 50 million ARR, then everybody wants to work with you. And then like the banks will do anything it takes because they want the IPO fees. Yeah, exactly.
So, I mean, since non-dilutive funding is all the rage these days, right? Everyone's talking about it. There are a bunch of companies that are popping up that do what you guys do, right? What would you say is the thing that sets you guys apart from everybody else?
Yeah, I think that right now, actually, there have been a lot of companies popping up, and some of them are really suffering. Like you see in the news, some are like firing a ton of people and like retrenching on what they know how to do best and so on. I think that the difference between them and us is that we chose from the very beginning to focus just on one vertical, on SaaS, and do extremely well, and then launch new products, and launch more products, for the same vertical that serve more pains and then also complement each other, right? So product 1 plus product 2 is better than product 1 from Capsys and product 2 from somebody else. So then why choosing one vertical was so important is because, companies are trying to do alternative financing for everybody. The reason why they're doing is because they're trying to access larger TAMs. What that leads to is that, yes, they can access larger TAMs, but then the models to serve those TAMs actually don't understand anything because they're looking at, let's say, an e-commerce company trying to understand it at the same time as a SaaS company or as a, lawyer company. And then what happens is that when the market goes well, nothing really matters because those companies are growing revenues and so on. But when the market goes poorly and then there's, some systemic risk and then companies are just not performing in the same way as they expected, then understanding that vertical really pays off, right? Because then you can really understand what makes a good SaaS company, what makes a great SaaS company versus what makes a good SaaS company, a good lawyer company, a good e-commerce and so on. So that was the key difference. And then I guess solving for founders, right? On the product, investing in product that can help to drive the cost down for founders and not just deploying more capital.
Do you guys support founders outside of deploying capital?
Yeah. So with the analytics product, that's free for everybody. And it is the first product that combines banking, expenses, data with revenue data, with accounting data, and combines the three of them. So that's free for everybody. And then we are launching more products, more in the payment space and revenue management space that have no funding capabilities.
Mm-hmm. Is the accounting product already live?
It's called Capsys Analytics, and we're rolling it out to the first dozens of users. But yeah, it's live. We would love to give you an account and just get your thoughts on it.
Awesome. Well, what does the future of Capsys look like? What are you most excited about?
I'm super excited about everything that's coming up now because I think that right now is what I've been the most excited ever for a few reasons. One, we really understand the market now, the SaaS market. And it feels like when you look at the market, SaaS, IT budgets, which is a proxy for the health of the SaaS industry, are increasing even when everything else is not increasing. So that's very exciting for every founder that we work with. And two, I think right now we understand the industry really well and we can launch new products to solve more pains that don't involve just financing, right? So then we're starting to hone on the mission that we set out to do, which is help SaaS founders with not only capital, which is what we have been doing until now, but also insights, the analytics product and tools. So mostly, revenue management and payments and so on. And it's just the initial feedback is amazing.
Yeah. So what are some final words of wisdom that you want to leave with our listeners today who are bootstrap founders focusing on driving growth and profitability?
Well, I think that something that comes probably very innately to bootstrap founders, but it's more important than ever today, which is 2022 and probably the next 2-3 years are going to be the years of or instead of and, right? So as in the previous years, you could do this initiative and this other one and this other one and just try them and see what sticks. We really need to choose right now, what are we going to deploy or what's the basket that we're going to put our eggs in and where we're going to deploy our capital in a very thoughtful way. And that goes from really high level, what are we going to do as a company to, every single person, what are they going to do with their time, with their energy and with their attention. But we need to be really, really, really focused and see things through as opposed to try multiple things that end up draining resources, funds, and people. Because focus essentially is what gives a startup the advantage and the pointy edge to beat a large corporate and capture a market.
Yeah, and I think that's especially true for bootstrap founders. You're almost always choosing. Every day I'm choosing between should I do this one thing or this other thing? Miguel, thanks so much for taking the time to share your thoughts with us today. If you enjoyed this episode, don't forget to subscribe to Profit Led and be notified of new episodes. Head over to our website, profitled.fm, to see the show notes of this episode. Miguel, if people want to connect with you and learn more about CapChase, where can they go?
Yeah, feel free to send me an email to miguel@capchase.com or connect through LinkedIn or Twitter. My name is Miguel Fernandez, CapChase. So yeah, looking forward to helping anybody in any way and just running ideas.
Awesome. Well, thanks so much for your time.
Thank you, Melissa. It's been a pleasure.
Thanks for listening to Profit Led. If you enjoyed this episode, we hope you will subscribe to the Profit Led podcast and head over to our website, profitled.fm, to see the show notes of every episode. You can also join our mailing list to be notified of new episodes or when we have interesting products and resources to share. We promise to only share things you'll actually care about. Thanks again for listening. Bye now.